The problem people have now is completely different. They have information overload. You can find anything and you can see 62 million different variations of that.
On derivatives, could you explain that for the viewers listening in? Like, what is that, and to give us some insight?
The concept of a derivative is it's a security whose value is derived from something else.
Can you share us with like a shared screen of like maybe a trade that you've taken? That way we can see more of how you go about trading.
So let me show you something.
Wow, this number really blows my mind. Over 75% of you who watch the show regularly are not subscribed. If you enjoy the show and want to support us, the easiest and also free way is just to hit that subscribe button. This will help us find new and better guests, and I promise you to continue to work at making this show better and bringing you more value. Welcome back, everybody, to Be the Trader. Today is going to be a fantastic day because I have my man Eric Smolinski. He has been trading for over 18 years, and he's going to be sharing a lot of insight, not only into his story, but also into his ideology around trading and strategy. And we might even go into deeper around sharing screens. So Eric, welcome to the show, brother. And I'm so glad to have you here.
Absolutely awesome to hang and talk trading. You kind of find that trading is one of those weird things where it's like all your friends and family, they kind of look at you and they're like, yeah, that's like cool. I don't get it. So anytime there's a chance to talk to other traders, I'm always there.
That's awesome, man. Well, let's get everyone up to speed on how you even discovered this world.
Yeah, it's funny as I look back at a lot of like random instances in my life, it's just happenstance. But I really believe in the concept of luck meeting with opportunity and preparedness. So it was back in high school. I grew up with a single parent, low income. We struggled to make ends meet. And I had a high school teacher that saw that I was working a ton of jobs. I was always asking for different odd jobs. Do you need me to shovel your driveway? Do you need me to move stuff, take your trash out, whatever? Like, I'll come do it. And he was asking, like, what are you doing with this money that you're making? I was just like, oh, I'm saving, because my mom set a fantastic example with respect to working. She worked super hard, but she was not so great with the management side of the money. So I always thought saving was a thing. He introduced me to the idea of investing. He said, you should invest this money. Literally, I'd never even heard the term, didn't know what it meant, but I trusted this dude. So I said, how do I learn? And he said, go to the library. Literally, OG, this is back in the day. This is '07. So I literally walked my happy butt up to the library. And the librarian, she showed me to a couple books. She was actually really, really stoked that I had even asked about that topic, because where I grew up isn't that kind of place typically. Okay. We walk through metal detectors every way to go to school. Like, I got stabbed in my hand. It's not like a happy, chill school, it's a different kind of thing. So she was super stoked to help me. She set me out with the stack of books, and I just started flipping through them. And that's literally how I found investing. It was 2007. So I was I must have been like 17, something like that.
Okay, cool.
Yeah.
Okay.
Yeah. So, and I really had no idea what I was doing, obviously, but I was really eager to try to figure out how to do something to make the money do something, because I was really good at saving, but that's essentially all I was doing. So it was between him and that librarian that I found investing, and it literally is an absolute lifesaver. It sent me down a completely different life trajectory, bar none. Even if I just invested at that point, didn't start trading. The cool part about trading is that it really amplifies the timeline if you can figure it out, which it's something that you literally can figure it out. There's nothing that psychotic about it, but it's just not as easy as a lot of us think it is when you first start.
Absolutely. Absolutely. So let's talk about that, because you discover it, right? You're about 17, 18 years old. And what is it like after you read those books? Are you immediately throwing money at it? How much did you save at that time? And curious, what were you saving for at the time before you found this? We cover a lot of information on trading here on Be the Trader, but none is more important than the broker you choose to execute your trades. There are many reasons I use Cobra Trading every day, including multiple order routes where I can get fast execution, great availability on locates for hard to borrow stocks, and fantastic customer service. But don't just take my word for it. Both Benzinga and Forbes Advisor have awarded Cobra for best in class for short selling and day trading. Isn't it time you choose a great broker that you'll enjoy working with? Sign up now by using the link below, and Cobra will give you 100 days of free commission, 3 months of free software, and 33% off commission for life. I know you'll be as happy as I am when you trade with Cobra. Now let's get back to the show.
I had no idea what I was saving for. I just always knew that money was hard for us to find, and I didn't like that feeling. So I wanted it to be more like if we needed money, that we had money to pull from. Because like my mom, she was an occupational therapist, but she was a contractor for a public school system. She wasn't making a bunch of money.
Yep.
And like there were periods where her car would break. And my brother and I literally learned auto mechanics because we couldn't afford to take it to a mechanic. So we became the mechanic. Yep. And then there's one of those instances where you're doing something simple like an oil change and you forget to pry off the old O-ring. So there's 2 O-rings and the oil just starts blasting out. And you're like, that's a lesson learned right there. Got to check for that. So it's like a series of these random things like that it led me to like clearly identify I like cars a lot and I got into auto mechanics that way, but it definitely taught me the value of having capital to do things. So I didn't really know what I was saving for. I just knew having money was better than not. And at that point, I mean, I was splitting wood, I was moving shale, I was selling Christmas trees, like I was shoveling snow. Everything. If there was something for me to do, I didn't care, man. Like I'll come do it. And I just started stashing all this stuff away. I had a couple $1,000s, and we started with the most base premise when I was like talking with my mom about what I was learning, and she didn't know anything about this. And I ended up coming across the Peter Lynch and, the invest in what you know. Yes. So there was a couple companies that I thought were just super cool. One of them I was absolutely so stoked for because you would be at home and then the mail would come and you would get DVDs in the mail that you could then play. It's a company called Netflix. And I bought Netflix because I thought it was sick, and Amazon started to become a bigger thing. So I bought Amazon. So I bought a bunch of these like random stocks that I knew. Paychex was another one because that was like referred to me by an older family member that stock did well for them. And this again was like before the global financial crisis. So the stuff was doing pretty well. But the funny part is I couldn't afford many shares. So even though the percent returns were great, the dollar returns were negligible. So I was just like, I got to speed this up. Like this ain't it, right? Yep. It's the standard young man patience, which we're just renowned for. It's that now honestly, my patience hasn't gotten much better. So the fact that looking back, it was that bad is telling me something. But yeah, I gave it like a couple months and I was like, I got to do something else. So I just kept scouring for any source of information I could find. And I came across all different kinds of styles, and that's when I found derivatives. And I genuinely fell in love with them because they're fascinating in a very strange, nerdy way. I do find them beautiful because they do such a good job at what they're supposed to do. And there's a lot that they do that I think goes underappreciated. So I just got completely sucked into that world. And then I have a super obsessive personality. So as soon as I found those things, I mean, I was latched, and I would spend literally all of my excess time trying to learn more. But that's essentially the path to get started, what I started with, and the kind of things that I started investing in.
On derivatives, could you explain that for the viewers listening in? Like, what is that, and to give us some insight?
Yeah, so for the retail side, the most common derivatives you'll hear will be options and futures. Then there's a whole other side that's much deeper that has like variance swaps, different kinds of swaps and things like that are also derivatives, but more on the institutional side of stuff. The way to think about options and futures is the concept of a derivative is it's a security whose value is derived from something else. So there are things that come up with different directional ideas, not necessarily just directional, but that's the easiest way to start. Volatility is another one. But it's a way to speculate on an underlying stock or underlying security and play it with leverage or play different assets or different components of that asset. Because if you buy stock, you essentially can make money if it goes up. You can make money if there's a yield via dividend. And then there's buybacks, which also pushes the price up. That's kind of the way you're going to make money in most, long equity positions. In options, it's very different. You can trade things that are trending sideways. You can trade a completely different asset class called volatility, which might not even care about what we would refer to as the delta side of the equation, the directional side, but the volatility side. Volatility is just how much something moves. So derivatives open up a completely different world of what we refer to as strategic investments. And it allows you to build things that are hyper specific. Do you want to trade something that you think might go up 0.5% over the next 2 weeks? There's a way to maximize that. Is there something that you think might trend sideways over the next 2 weeks or 2 months or whatever? There's a way to trade that with options. That's the whole world.
So, I mean, you obviously sound like you know what you're talking about when it comes to this subject, right? So, how long have you how long did it take you to really dive and learn all of this topic to start to see consistency in the day trade world of options?
I would probably say I'm not the brightest bulb in the box, so stuff comes to me pretty slow. I kind of brute force stuff. I just look at it long enough until it essentially becomes undeniable. It's like you can't look at something for too long and not eventually get it, especially stuff that's still relatively approachable. It's not like theoretical physics. And probably 3 years, I would say, is when the light bulb started going off. And then I would probably say it wasn't until like my 6th year, really my 5th year, but my 6th year is when I developed something that I really trusted and I knew I could scale. 5th year is when I had a completely revision of what I was doing, a complete revision. So that year was really unique in that way. So yeah, I would probably say like maybe 3 years until I really started to get it, 6 years until I had something I knew I could use. And again, this was also during high school, which you have a ton of extra time. And then also during college, where I had a ton of extra time because I was there on a Marine Corps scholarship. So I did have ROTC, which burns a bit of your time each day, but not that much. And so all the spare time was completely directed towards this. Because a big thing I remind people starting now compared to when I started is the problem people have now is completely different. They have information overload. You can find anything and you can see 62 million different variations of that thing. For me, in a way, it was much simpler because that didn't exist. Like you literally had to like go read books. There wasn't a lot of these online resources. So that naturally created a pretty strict funnel, not perfectly strict. So it was easier for me to just move through each piece that I could find. But so that also slowed things down a little bit, like being able to like rapidly find, test ideas because the environment was a lot different.
Yeah, because you're learning in a whole different way. And so, in terms of information, like you said, and so testing other ideas could take a little bit longer, or even finding ideas and generating new ideas. So, that's interesting. What I'm curious about is what happened on that 5th year, because you said that 5th year is when things really took a big shift. What was that?
So, in my 5th year, are you familiar with the Dunning-Kruger effect?
Yes.
Yeah. So that's effectively what happened. And for those that are unfamiliar with the Dunning-Kruger effect, simply put, when you first start learning something, you have low confidence because you're new to it and you have no competence. You know nothing about it. What ends up happening is you focus on it super heavily. You spend what you perceive to be tons of time, and your competence rapidly raises objectively from your baseline of 0. You start learning basic terms, definitions, stuff like that. That plants a seed in your brain where it's like, oh, I know this. I know so much about this. Whereas in reality, your confidence has actually skyrocketed and your competence hasn't moved that much. And sooner or later, most of us, we step in front of a poor event that leads to a rapid unwind of your capital, AKA either blowing an account or a big drawdown. For me, it was a big drawdown relative to the percent of the portfolio, the largest one I've had. And at that point, I had binders with notes. I had written out strategies. I had Excel sheets built. So like I was taking it pretty seriously, but it was all random. Like nothing was really connected. It was just kind of like these random thoughts. And I put on a trade in the rut that was designed to make like a few $100 over a couple weeks. And it was a super wide iron condor. For those that don't know what that means, all I'm betting is that the Russell 2000 index is going to stay within a range. And when I put that trade on, I was so focused on what I was going to make because it was a super high probability trade that I didn't conceive of the path it might take to get there. So it had a bad path, meaning one side of the trade was challenged, which leads to a spike in your unrealized profit and loss, right? The open trade. And I wasn't prepared for that. So I saw it, I kind of digested it, and then I said, I got to take this down because this is outside of what I was expecting to happen. So got to reevaluate. Took it down. My favorite part about that is it ended up being a complete winner, landed right in the middle of the range. So if I hadn't touched it, it would have been perfect. But I wasn't ready for the path that it might take. So I took it down, had a massive drawdown on the portfolio. And I literally sat down for a second. I said, what now? Like, what do I do now? The fortunate
What kind
part
of massive
is
drawdown, just to give relativity to those who are listening?
It was, I can tell you specifically what it was, but I want to say it was like 30-40% of the account, which for most people, that doesn't sound too crazy because I know a lot of people blow accounts. But for somebody like me that grew up in a really scarce financial environment, seeing essentially like my mom's annual salary go away was like, oh shit, this is a problem. So that's a whole other bag. That's worth noting though, like understanding the way that your mind is approaching trading. Because I approached it from a scarcity mindset. I was terrified of losing because I didn't come from much, and any incremental loss is punishing. But that's a massive mental problem that you got to get over at some point. But in this case, it was like a 34% drawdown.
Okay.
And when that happened, I essentially said, what am I going to do? But I was really fortunate in that by that point, I had already a pretty good proof of concept because at this point, again, I was in college and I was making good money by trading, especially compared to the people that were working at the sandwich shop on, campus, making minimum wage. I was doing way better than that. And also at this time, I was already into like flipping cars. I leveraged the skill that I learned out of necessity, but I started buying broken cars, fixing them, selling them. So feed that into the trading account. Anything, man, literally anything.
That's awesome. That's awesome.
It was anything.
Yeah. And hustler from the beginning. I love it.
Dude, it was the only, only way. It was the only way. That is like probably
by the way, thank you for your service too, man. But that's awesome.
Thank you, brother. Yeah. My pleasure. But that really set me in two complete different directions. I said, I can either stop, I can switch to buy and hold, but I know I can do this and I know it works because I have some sort of track record. I made a mistake, but I think I can still do this. So then I called like a full operational pause, stop trading live money. And I said, I literally just set out a plan of how am I going to fix this? And that's when I chose to get super, super serious about it. That's when I came across a mentor that I never met online. And he was this old grouchy dude that traded options. And I was posting about, the stuff that I was doing, the stuff that I was learning, and then trying to figure out like what I should be doing. And he would say stuff like, well, what's your trading plan say? And I was like, I don't really have one. I kind of like figure it out as I go, right? Like you just feel it out. And he was just like, no, you don't. So I was like, all right. So I got into creating like a written trading plan. And that's probably one of the most pivotal moments where I realized, even though as serious as I thought I was taking it, how much I was just winging everything. Because I would write down what I'm doing and then I would say, okay, like what do I do in this scenario? And I was like, I don't have something for that in here. What happens to this scenario? I don't have something. And I realized there's a bunch of those. So I had a bunch of scenarios that I wasn't considering. And the process of making the plan is light years more important than the plan itself. That's what I've learned. But that was the big change.
That's a really good, that's well said, man. And can you go a little deeper on why you said that? The process of making the plan? Go ahead.
Because if I deconstruct the loss on the account that was the largest percent drawdown, that's because a situation popped up that I didn't even conceive of. I didn't think of it because I was focused on myopically on one part of this trade. When you're writing a plan and you essentially are writing it in the context of, if this happens, what might I do? Now, to be very clear, the way that my plan is written is not to take away my discretion. I actually think that's one of my edges as a trader, is partial discretion. Now, it's really dangerous to say that. You have to have stuff that backs it up, but I do believe that. So what I'm doing in the trading plan is I'm typically giving myself parameters. If this happens, these are a couple things I might do. So in the process of writing a plan that covers those kind of scenarios, it literally forces you to think through all of these different kinds of scenarios. So then all of a sudden, over the life cycle of an individual trade, there's way less stuff that pops up that you're like, I didn't even think of this, or this came out of left field and took me completely off base. There's nothing like that, because generally you're like, I kind of thought through this. This is what I think I should do. And more often than not, that decision-making process is going to serve you so much better than trying to build it as you fly. A big thing that we do in the military is a planning process where we sit down, we have intelligence, and we make these big, beautiful plans. When we're making the big, beautiful plans, we know without a doubt it's not going to look like that. We all know it. We'll still spend all the time and effort to build the thing that we think it's going to look like, but we know it's not going to look like that. Why do we do that? It's because we know that if we have something that's pretty close that we can call audibles off of, we are so much better off in that scenario than the scenario of just go in and figure it out. That works poorly. That's exactly right.
That's huge, man. And so you meet this other trader, and he's an elderly man or older gentleman, right? I don't mean any disrespect. I just don't know the guy. And let's say he tells you about planning. Like, what's your plan? So you start to dive deeper into planning. What were your plans before that, and versus what you just explained? Just so that the people who are listening, they're going to be like, oh, I may be like that before. So,
I guarantee you, most new traders are. The funny thing is I've spent enough time talking with traders and seeing traders is like, we all do the same stuff, slightly different versions, slightly different degrees, but we all do the same stuff. And it's because we're all humans. We have the same general ideas that we're trying to exhibit. But the main stuff that I would do is I would like see something that just catches my eye in some way. And then I would say, oh, well, I think that's up too high. I should sell it. And then I would put on something to sell it. Like, that's kind of the plan. And thinking about that in a vacuum, it's like, that's not a plan, dog. Like, that's nothing. That's me seeing something completely random, forming a random idea, and then just being like, I think this. That's not it. That's not going to work long term. One of the big issues that we all have as new traders is we become way too invested in the outcome of individual trades versus what is the background process that's going to lead to the thousands of trades you're going to take over your career. And when you shift your mind in that way, you focus way less on finding these seemingly unique unicorn circumstances that might make you tons of money. Those happen. And some people are really, really fortunate that they'll find those, but they're rare. I know it's not the case for me.
Longevity, it's hard to build longevity on that.
Super difficult. And again, some people can do it, but it's very difficult. So by focusing more on the decision-making process and the way that you find ideas, the way that you manage those ideas to have a positively expectant system, that becomes the guidepost. And with a focus on that, you're way better served. So what that means is when I see that same thing that it looks like it's too high and I want to sell it, now I ask more questions. I say, well, why do I think it's too high? Is this objectively too high? What's its return over the last 52 weeks? How does this sit on a standard deviation channel? Is there new money coming into this? Does this thing have a bunch of really smash earnings that is leading to a bunch of institutional money flowing into this, driving the price up? Because the allure for a lot of us is to be a contrarian. Being a contrarian sounds so smart, right? People are the sheep, everybody's dumb, and I'm the smart one. And you start to realize, like, Nah, dog, like most of the time you're on the wrong side of that. Most of the time when you're trying to play contrarian, you get ran over. Now, there's a way to be contrarian, and there are absolutely instances that I will run contrarian plays. But to always default to a specific mindset like that, I think is super limiting. So
Yep.
the way that I think about trades now, conversely to that original scenario, is first I contextualize what's going on. Why is it at this spot that I think is interesting? Maybe I'll run some basic analysis on it. Is the average daily range expanding, right? A proxy for volatility.
Mhm.
Is the sector that it's in starting to do well? Okay, fine. Let's just say that I still think it's too high and it should go down. Now, a big difference is I'm going to say, where am I getting out if it keeps going up? Where am I wrong?
Yep.
Where am I wrong in this directional idea? Because the point exists. I just have to pick it. That's the first thing. The second thing is, how am I going to manage this thing as it goes, hopefully, in my direction, in this case, down? Am I going to take full profits? Am I going to wait until it gets to this point of perceived resistance? Blah, 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 all this other stuff. So the main takeaway there is not necessarily the specifics, but it's the thought process moving from, I think this thing is too high, let me sell it, to, I think this thing is too high, let me sell it. In this context, if it goes to here, I'm wrong, I'm getting out. If it goes to here, I'm right. Maybe I'll set a stop limit. Maybe I'll take partial profit, whatever, but we have some sort of management plan in both directions.
Yep.
It's so simple, but most of us don't do that.
Yeah, it's interesting because you're already making money at this point, and yet you were not doing that step. And so it even shows, like you said, after that year, you really start to see even more growth and more confidence behind your trading because like you had more of a plan. Was there anything else that contributed to that growth?
I think the other thing I would mention is what we talked about before, actually. So you bring up a really interesting point that I think confuses a lot of people, which is the path. And path is really simple in a statistical concept. It's just the way something goes, right? You can have something that has just a path that somehow favors the upside. Think of market drift to the upside. That's a positive drift. That's a normal path that we see. But just because the market has a path of normal drift in a really long-term time frame, in short-term time frames, it can go the other direction. So I was really fortunate, again, because I started with a really scarce approach to markets, that I was really nervous to put a lot of risk out. So that's why during GFC and stuff, I didn't get eaten alive because I didn't have that much out because I was scared. I didn't want to start losing money. Then I had a favorable path. The stuff that I kind of was just spitballing was working. And it worked for a few years in the aggregate. Still had plenty of losing positions, but in the aggregate, it definitely worked. Not a lot, but minorly. Then after that, I really came to the realization that like overemphasizing individual trades is a massive mistake for my approach, and focusing on, again, this idea referred to as market effects and profit mechanisms was going to be the way forward for me. And that there, coupled with tracking what I was doing, is literally what changed everything. Because essentially I would say, here's a market effect that I see. Let's say post earnings announcement drift. It's definable. I can see it, I can study it, I can measure it. So I create a profile for that profit mechanism. Then I find how I want to trade it. I fit different options structures, and then I build a strategy out of that. Now I'm not focused on how does my post earnings announcement play work in stock XYZ. I worry about how does my post earnings announcement strategy work across the basket of stocks that I trade that in. And that made it so much easier because all I would do is track what I'm doing, see what's working, the stuff that's not working, figure out why, conduct an adjustment, and then observe again. And it's just this iterative process. But that iterative process becomes super, super informed when you track stuff. That's it. Like literally, if you track stuff, you'll see it. And then you'll start to say like, this sensation I get when something's really high and I think it's going to go down, I'm losing most of the time. And it's really negatively expected. It's a bad feeling. I need to do something else. But if you don't have that feedback mechanism, our brains go through all sorts of mental gymnastics to try to make our egos feel okay instead of just directly being okay with being wrong, which you're going to be all the time as a trader. We try to say like, oh, well, this happened because of this unique circumstance, and then this, and then you're incentivized to put on a bad trade again. Getting rid of that habit got to happen. And if you track stuff, you'll see the habits.
It's funny because you said it a couple of times, and that is the number one, you grew up in a scarcity mindset. So how I want to dive into that first topic. How did you
Sure.
overcome that, and how did it enter? You said it was a benefit, but also what was there any cons to that, and what were the cons to it as well as the benefits? I know you mentioned one earlier that you stayed around for a while. You didn't blow up big because you didn't put a lot of
Right.
money right away, which is good. It gave you patience. But then the con is, how did you size up? Like, and how did you get over that? So just curious.
Yeah, you hit the nail on the head with respect to the drawback. Is it becomes very difficult to scale, because even if you're sizing things as a logical amount of the portfolio in terms of how whatever the strategy is and what size risk it deserves, you see the gross dollar amount and it still makes you feel some type of way. And the way that I started to get over that was two different approaches. The first thing is, when I would trade live in the account, I would also trade different variants via paper trading. And I would just do it like an Excel sheet so I could track. It was for me to log data, but I would log some of the variants at much higher size. Desensitization. Just see the numbers. Just get used to seeing the numbers. This one looks like this. Then when I want to scale the account, I just slowly scale it. So maybe I move from a 1 lot to a 2 lot. It's the smallest move you can make. But instead of going from like a 2 lot to a 5 lot, maybe a 2 lot to a 3 lot, 2 lot to a 4 lot, stuff like that. Because for those that don't know, in options, you deal in lots, which represent 100 shares of stock. That's leverage. So it can get sizable quick. So then you can also create different kinds of spreads to offload some of that size, but that gets a little technical. But a big part about that is very carefully scaling. I think desensitizing, seeing the numbers was really important for me. Get used to seeing it and then slowly start scaling.
That reminds me of another trader I met. It was Jack Kellogg, and he was saying that he would always put in his head, if I made two, like when he first started, he'd make $100, but he'd say I made 1,000. But if he lost 100, I lost 1,000. So he could slow, because then when he made 1,000, he said I lost 10,000 or whatever. He always increased it in his head so that way he could continuously push.
Super smart.
So desensitize. I can't even say the word. But
Desensitization.
Desensitization.
There we go. Yeah, you nailed it. You did great.
Yeah, there we go.
You did wonderful.
Yeah. So to give people perspective, because they hear, you were making money, then you meet this gentleman, you make this pivot, then you see way more growth. Can you give us perspective on what kind of growth differentiation between the two?
Yeah, definitely. So my first few years, so within my first 5 years, my best return was still sub 20%. Then post that, my worst return was up 13, 14%. Everything above that was pretty smooth sailing. Now, one of the things to note is a big part of my trading was never built around having these smash years. And I really valued consistency, again, scarcity. Yep. And also, I was okay with the trade-off because I knew as I was learning to trade that I would be absolutely fine working my ass off to feed the account in order to move quicker. So I knew that if I kept saving...
There's different ways to get there. There's different ways to get there.
If I kept saving like a madman, but had really consistent returns over that time frame, then my account would scale very quickly. My original target was $1 million before I was 30. And I found by just looking at a compound growth calculator that you don't need 100% years to get there. What you need is pretty consistent 15% years. And this accounts for when the market is down. So in 2009, market was down 37%. If you're not down that much, then your starting points for the next year or whatever time frame you choose to choose is that much higher. So you don't need to have these crazy huge years. And I learned early that as I was testing different kind of strategies to see if I was capable of that, most of the time it led to ruin, meaning just huge drawdowns of the account. So it can work for some people. The most ironic thing about all of this is my absolute best trading has been the last 2 years. And they're the 2 years that I've had the lowest return targets. Each year, I typically set a baseline. Like if I
Okay.
hit this number, then I am on the correct path for, the broader goal. And as the account grew out of conservativeness, I would guide that down slightly so that I knew that I had a low bar that still, as long as I hit it, I'm in a good place for going forward and continuing to build and be able to live. But then I still will take opportunities when I see them. And the last 2 years have been absolutely like just smash years. The average between them is 105% over the last 2 years,
That's
which
great.
is nuts. I've never had anything like that. It was, just very, very different, because as I started building more wealth, I really diversify stuff. So I split stuff out of the trading account, and then I get into angel investing, real estate. I'm like continually trying to create robustness, because the other fact that I think about a lot is like, if I die, my mom doesn't know how to trade, right? Like none of these people know how to trade around me.
Yeah,
Like,
that's a good
I'm
point.
I'm the dude that does it. So what I do know is that my mom knows how to cash a check, and that check is going to come from a rental property.
Yep.
So it's like it's stuff like that where I really try to think about robustness in the system while I'm still aggressively trying to grow the account. But the main thing to summarize all of that is I do believe, especially early enough, if you aim low enough, you might hit the target, which is a really strange thing to say. A lot of people are like, aim higher, have higher standards. But the problem is, in pursuit of somebody that's in their second year of trading, trying to consistently outperform the market, like think of the ego that goes into that. There's been people doing this for literally decades, and they still are trying to pace the market, beat the market. But somebody who really still doesn't even understand the system, objectively speaking, in a 2-year time frame, they're thinking, I'm going to start smashing everybody. Maybe that person is the gift. And again, there are always these outliers.
Right.
However, they're few and far between. So I find focusing on like a more sustainable growth path be way more realistic to actually hitting the goals. And then you could be pleasantly surprised.
Yep, absolutely. And so would you say, how active are you in the market? Since your way of trading is like waiting for those unique opportunities. You mentioned, you called it between X and Y? What was it called?
Oh, profit mechanisms.
Yep, profit mechanism. So like, are you very aggressive? Like every day you're on multiple positions? Like, just curious.
There's always stuff to do. So the way I look at it is, if you have a wide enough toolkit, there is literally always stuff to do. So for example, right now we're in earnings season. There's like 4 different profit mechanisms you could trade for earnings. You can trade the implied volatility expansion into earnings. You could play the implied volatility contraction post earnings. You could play the catalyst of the earnings day and the continuation. You could play post earnings announcement drift. That's 4 things on one effect. One of them starts 2 weeks out. One of them starts the day before. One of them starts the day of. The other one goes for the next quarter. So you can literally build, that's on one stock. So you can kind of expand that out. Like my book varies between like how much I'm sitting in front of the computer and stuff, but sometimes I won't trade at all. That's kind of rare now, especially with like zero DTEs and stuff like that. But the majority of the time I have pretty active positions on across time frames. So the book can be anywhere from 10 positions to 300. It really has a really wide spread based on if we're going through something like an earnings season or if there's other effects that I'm looking at.
Have you found that difficult to manage? Like whenever you're in like multiple different types of time frames plays, like how do you keep track of that? Or do you keep track, or you just keep it all up here?
Super easy, man. Like the trade log. So what I do is I build, like I was telling you about before, just an Excel sheet that helps me see and split out my different strategies, because I trade with Thinkorswim. I've been with TD Ameritrade before Schwab bought them. And I've just used them. I enjoy the platform, but the platform doesn't know what strategy I'm running when I'm putting
Right.
on a position in something, right? Like, so I have to do that. So I used to have it fully automated, but I actually didn't like that. I found when I fully automated it, it led me to being like a little too far removed. And what you'll find is if you trade for a long time, a big part of what you do as a trader is you look for things or you spot things that look weird. You see something enough and then you see a deviation off of that. And you just say, that's weird. I've seen this hundreds of times. Why is this different now? And a lot of times that leads to a trade idea. Sometimes some of the best possible trade ideas this year is a great example of that. There's been absolutely fascinating relationships between stuff like volatility products, indices, gold, Bitcoin, like the relationships between these things, not even talking about the bond market. So when you see these anomalies, a lot of times it leads to different ideas. So I like to stay pretty close to the bubble. So I literally use a trade log that's partially automated to do different tasks for me that are a little more menial, but I literally just use a Google Sheet. And I used to use Excel because I did a lot more kind of like heavy lifting, but more of the heavy lifting and stuff like that I normally do in Python now. So I track everything in there. And what I would tell people is if that kind of stuff sounds like really overwhelming, the simplest thing you could do is just start. Start with the simplest thing that you will consistently do. Then you can build on that over time. But I will literally guarantee you, you will be light years better off if you just start versus thinking about conceptualizing how great the thing is that you might make at some point. Just start.
Yep.
Because it's the saying that you might have heard before, but it's how do you eat an elephant? And one bite at a time. The whole idea is if you're thinking about eating an elephant and you think about the process of eating an entire elephant, you quit before you even start. It's too big to even consider. But if you literally just start, you put some of it in a freezer and you get on an elephant diet for like 8 years, you might get through it, but you can get through it. It's kind of a similar idea. Like just start and then it'll take shape over time. It's not going to be perfect in the beginning, but it's going to be so much better than nothing.
You know, what would you say has been the most challenging for you after you started to make money in trading? What was the next most challenging thing?
Not really anything, to be completely honest with you. Like the interesting thing is once the thing is built, it's really not that difficult to maintain. Like most of the work that I do now goes into researching new variants of things, researching new profit mechanisms. But like, I legitimately like that. It's like searching for stuff and building things, which I really enjoy. Now, to be a little esoteric, I do think trading, like it can be very solo. It can be very, very solo. Like I was telling you about before, it's not like I can go talk to somebody and be like, hey, I'm trying this new vol arb strategy and this is what I'm like, there's just, right, there's no conversation there.
Yeah.
So that part is a little challenging, but with the internet now, like honestly, that's not really a thing. Like I'm sitting here talking to you about trading, right? Like that's the beautiful thing is connectivity has gone up. So it really isn't difficult anymore. It's like it's quite easy, I think, but that's not to dismiss all of the work that goes into making it easier. But the way I think the way I think it's useful for people to think of it is like if you consider like a professional athlete that's been really good at the sport for a long time, they typically make it look easy. And it's just because they've spent so much freaking time doing it that it literally becomes relatively simple for them to do seemingly extraordinary stuff. That happens in trading. Like if you stay exposed to it long enough and you're regimented in terms of what you're tracking, you're building good contextual windows so you understand what stuff looks like and then deviations off that stuff, then all of a sudden stuff really does start becoming a lot easier. And then there is also the tailwind of when your account size grows, it's so much easier in terms of testing different stuff because it's no longer like, hey, I'm going to, move this to production. I'm going to go live with this thing. And if it fails, there goes 80% of my account, right? Like that doesn't happen anymore. It's like, I'm going to move this to production, try minimal viable size. And if I lose 0.2% of the portfolio. I literally don't care. I
Yep.
can see how this goes. Yeah. So it's not
It
to
gets more
dismiss the effort.
fun, like more
Yes,
fun, because then you can
absolutely.
like try other things.
Absolutely.
It's pretty cool.
Yes.
Yeah.
Yes, you can test different ideas. Like I have to imagine for your trading style, how many styles have you tried over your career?
Oh my God. I mean, from small caps to now, mostly just like a swing, intraday swing style. I
Okay.
mean, I've tried tons of styles. I mean, I wouldn't even be able to count, to be honest. I try, and then I
And
meet
then
so many traders, so then I even get more ideas, and then I try it. I'm like, I'm gonna test that out. I'm gonna test that out. So I've tested out so many. I like on the side, I like testing things, just like you just mentioned, and it
yeah.
becomes fun because you're like, oh, what if I find something else that's even better, or I can add more over here, and it's like creating multiple sources of income within the same world, which is pretty fun. So it's
That's
pretty cool.
exactly right. And then I imagine for the intraday stuff that you're doing now, it starts to become like pretty natural, right? Like you turn on, you see what stuff is, and you're kind of like, okay, I know what to do
You
here. I've
start to,
seen this, or
yep,
I've
you
seen,
start to get a
yeah,
little bit more pay. You start to like, it's just like, I don't know. It's just, you enjoy the day. You enjoy it a
yeah.
lot more. Like, oh, I'm looking forward to coming, rather than the beginning. You're kind of more like, I got to get this. I got to figure this out. And you mentioned something earlier, and that is when you were seeing every loss as like a big deal, or every independent trade. How did you overcome that? Because you did mention like you were able to overcome that and see it
Yeah.
as more of a grand scale, because that is a big challenge for a lot of traders who, they take a loss, they judge themselves right away. They take three losses, they get really pissed off, then they ruin the next trade that's a great winner. That cycle is really tough to get out of.
It is. And it also leads to what we call the disposition effect. It's another psychological trap a lot of traders fall into. And it's literally based on human nature, but it's where we have a propensity to take winning trades down too fast and let losing trades run. And a lot of it is still like ego driven. The thing that I don't know if a lot of people appreciate is like, even if you don't find yourself like highly egotistical and stuff, we all still have an ego. And the ego is pretty powerful in terms of like what it directs you to do and how it directs you to think about stuff. And I think it catches a lot of people off guard because I don't really consider myself like highly egotistical, but I acknowledge that there's one there. And to your exact point on what we were talking about, I could see some of those things where, well, if I keep the bet size small, I don't lose a lot, and that's better for me, right? Like that doesn't feel as bad. But the way that I started to fix that was when I would track stuff, it was so much easier for me to see in the process of tracking how things do. What's the average win? What's the average loss? What's the frequency of the win and loss? What are the tails? What's the worst I've seen? And then as soon as I see that, well, I can quantify for myself. I can say, well, if I run this strategy and I size it from a one lot to a three lot, that moves my loss potential to, let's just call it $3,000. I'm completely okay with that. That's no problem. So by focusing again on the process and the specific details of a strategy, it made it so much easier for me than looking at individual trades and saying like, oh, shit, I lost on this one trade and this sucks. This is X number amount of hours of my time gone and blah, 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 blah. You kind of get away from that because another thing that's really important to mention is like the emotional detachment of the capital. When money goes into the trading account, I started going through a process where like I literally stopped thinking of it as money. I just think of it as coupons in a machine. And I don't think of it in terms of the hours that I work or whatever, because fun fact, the better you get at trading, the hour discussion becomes so tilted in the other direction. Because when you suck at trading, you're putting in a ton of time, you're not really seeing stuff yet, and you're not going to because you're still learning. So then you're like, oh man, I just lost 3 hours of my time, blah, blah, blah. And then there literally comes a point where your daily P&L might fluctuate people's annual salaries. The scale comes, but it's just as things develop and grow. So yeah, focusing on the strategy is as weird as that might sound, moving the focus from individual trades and just starting to quantify the strategies as they are and understanding how those behave is super, super useful because then I'm not worried about if I move it from a one lot to a two lot or a three lot or a 10 lot or whatever you end up having to size up to.
You know, I'm curious, man. Is there any if you were like helping a brand new trader out and they were going to just like
Mhm.
start today, they're like, hey, you know what, man, I really want to get started in trading. What should I really focus on? And, for the first like month of my time, if I'm going to get into this world, what would you give them?
I think for the first month, I would say study markets in terms of their operations. There's a great book. I'll tell you the name of it. It's like one of the only books that I found that does justice on giving you kind of a good breakdown of the broad market operations. It's called Trading and Exchanges.
Okay.
And yeah, it's by Larry Harris. I don't know the guy, so it's not like some sort of plug because I know him. It's just a good book. And it explains the different participants. It explains how exchanges work. And as boring as that is, I think starting that process is really useful. And understanding that that's a boring process for that person that's starting off in the first month, you also have to give them some quick wins. So I think some of the quick wins would be open up a spreadsheet and type in the ticker of a stock that you like. You think it's going to go up. That's the most natural starting point for people. Write down the price and then come back a week later and see what it was. Just do that for a handful of stocks, right? Just get a
Yeah.
relationship with some of these things. So those would be the very two first things. And then from there, the big jump off, I think, would be getting people to stop worrying, especially options traders do this. They start learning options and they're like, oh, I got to know every kind of option structure that exists. So I'm going to learn all about verticals and then I'm going to learn iron condors. And it's because they're misguided. It's completely backwards. They think that there's some sort of edge in the structure and there isn't. The way that
Mm.
you find edge in markets is, again, by observing market effects and turning them into profit mechanisms. You had a great podcast. I don't remember the general's name, but he was doing research on, it was the social ARB guy talking
Mm.
about hail.
Yep. Yep.
That's
Yep.
a
Chris
market effect.
Camillo.
That's a market effect. The
Yep.
effect that he identified is when there is hail, the roofers go up in price. That's the profit mechanism. Market effect, hail, roofer up in price, profit mechanism, build a trade. That's it.
Yep.
So it's finding those kinds of relationships. And the beautiful part about markets, as we were talking about before, there's literally thousands of them.
Mm.
The trick is retail is there's nobody telling you what to do. There's no guidelines. So that openness is most people's natural undoing because, again, it's just unguided and we don't really know what to look for. We bounce all over. But great way to overcome that is go on to SSRN, Social Science Research Network. It's free, ssrn.com. Again, no affiliate with them, but I use it all the time. Type in something, type in stock market, type in stocks, type in options. You're going to come across tons of white papers. Focus on the ones that are peer reviewed, meaning other people have vetted the information that's in there. I prefer stuff from institutions because their approach is different. They're not necessarily there trying to push a product and agenda because you'll find funds and stuff like that also go on
Okay.
there. But that's also to get their rep up. That doesn't mean the information's bad, but there's a baked in incentive for them. The institutions, they just decide, I'm going to do research on this and here I go. So you can go in there and just get tons of ideas. One of the base market effects that everybody can start with whenever you feel like is momentum. Momentum is one of the most profound, well-researched market effects that exist. If you buy and hold an index ETF like SPY, that's momentum. Why? Because SPY rebalances. It drops the losers. It buys the winners into the fund when it rebalances. That's what momentum is. It's shedding the weak stuff, getting the strong stuff. So literally when people are buy and hold into an index ETF, they're actually trading momentum and most of them don't even know it. But it's a really accessible base market effect. So that would be the third thing. That's maybe more like a month 2 kind of thing, but it's starting to think about the markets in terms of profit mechanisms. What things reliably move, and then trying to come up with some sort of assumption around them. News catalysts. I tell you what, if there's another Boeing air crash, plane goes down, whatever, I know what's happening to Boeing.
Yeah.
There's an idea, right?
Yep.
So it's stuff like that.
I love that you talk about trading in that way, like profit mechanisms. You say effects and profit mechanisms, correct?
That's
And
right.
so, like, that's just really opens the mind to a lot of people who are listening to be like, oh, okay, I don't have to just trade trend lines. I don't have to just trade
Bingo.
indicators. I can think of what what makes sense to me and how can I make that into a profit machine, right? So I love that you position it that way, man. So I'll start using that idea as well. So I appreciate that because it's
It's
a better
good.
way to explain it because it can be helpful for anyone and not just the guys who just like technical analysis or so forth.
Well, and the thing that I tell people, even if you like technical analysis, like a trend line isn't a profit mechanism. A trend line is a signal. It's something that helps you spot a profit mechanism.
Correct.
So again, it's like correctly organizing these things in our brains, because if we want to research something and get better at it, we don't focus on the signal. We don't look at trend lines more and say like, what do I need to do with this trend line? We say, what is this trend line showing me? And it's showing you a profit mechanism. So what are the things about that profit mechanism that you might be able to amplify, whether it's with signals, trend lines, whatever?
Yep. That's awesome, man. So you know what I'm curious about? If you have some more time, can you share us with like a shared screen of like maybe a trade that you've taken, and maybe go over it so that way we can see more of how you go about trading?
Too easy. And right now, the beautiful part is there's literally a million things to trade. So you should be able to see the platform, and don't worry about all the stuff on here. Normally, I'll start with looking at the broad market. So this is when it feels like loading in its own time. We don't rush the platform, otherwise it can get pissed off and like close out. You don't want that. So homage to the platform, take your time. And I start with just kind of like a broad market analysis. So I want to know what the indices are doing, what's vol doing, what are bonds doing, what are commodities doing. You can see I track all those over here so I can quickly flip through them. And I like to just start with this kind of context, right? I use different kind of breadth indicators. So that's stuff like net highs, lows for the New York Stock Exchange and the NASDAQ exchange. And then I look at stuff like the percentage of S&P companies and other indices above a 50-period moving average, all that kind of stuff. So this stage is me doing nothing other than just getting context. Just want to know what's going on. Does anything stick out to me? Now, from here, there's a bunch of things that immediately stick out to me, even in this right now. The first thing is VIX is super low. It's down at 1483. If we know VIX and we know volatility products, we know that the long-term average is closer to the 15 handle, 15 and a half. So this is relatively low. That starts just painting the picture for different things for me. Now, to talk about an easy series of trades that's happening right now, and I can grab my watch list right now because most of them are earnings stuff. So if we go into a calendar, what I like to do is filter for stuff that has weekly options. And the reason for weekly options is it gives me better exposure to what I consider an earnings effect. And then I filter for earnings. So all of these companies are reporting earnings before the market opens or after the close on each of these days. I'm going to do a really high level overview just because I don't know if a lot of your audience is options traders, but I'm more than happy to go deeper in detail if you'd like. Just, let me know if we're going to double click in, but I also don't want their eyes to roll back.
No worries, no worries. And by the way, on that topic, if you do want us to dive deeper, we'll bring them back, comment below, and we'll dive even deeper later. So for sure.
Let me tell you, man, options go down Mariana Trench level. So we can go, not quite black hole.
We'll be here forever.
Yeah, exactly. Not quite black hole, but definitely quite deep. So let's say, for example, these are super recent. So we'll do a couple recent trades that reported before the market today. So we can see all of these different names. A couple that stick out to me were a MAT and then JD and DE. So let me show you something. Following an earnings release here, we can see that on this plot, which might not mean a whole lot to people, this is a price spike plot. This just tells me in terms of the move in standard deviations. That's all. So how heavy are things getting coming into an earnings release? So this kind of thing, to see this kind of really strong gap down, this move here was a 2.8 downside standard deviation move. For those that are statistical minded, you know that that's fairly rare. So a lot of times when you see these kinds of moves coming into an earnings, a lot of times the earnings becomes much softer in terms of the post earnings move. So then I care about something like the actual movement of volatility. That's what these lines are. The yellow is implied volatility. That's the market's projection of future volatility. And then the white lines are realized volatility. What happened in the past? How much did it move? So if this in and of itself is a prime time initial look at an earnings play, we know it's reporting here. The market effect is earnings are binary events. New information is going to come out that's going to be rapidly priced into the stock. The profit mechanism is the contraction of implied volatility and the relative overpricing of implied volatility. So what that means is we typically price implied volatility higher than what's realized. So that means that we're accounting for a larger range move in the options than what we typically see. So this is a great example of that kind of thing. So to trade something like this, I normally would trade the front contract. So this upcoming expiration, the 15 AUGs. And with something that's smaller like this, in terms of the options change themselves, you can play it a couple different ways. Normal, I'm just going to do a short straddle. So to show you what a short straddle, I'm going to use slightly longer dated options just so that you can actually see what the pricing typically looks like, which this isn't that, but here. This is what we refer to as a payoff diagram. So this essentially shows us how this option combination makes money. And effectively, the way that this combination makes money is if the stock remains within this point, which is like 189, and this point, which is like 136-ish. So if the stock stays in here, we make money. The takeaway is earnings gives you a ton of these looks, because coming through an earnings release, you're going to see vol collapse following the earnings release. So this weird looking graph, the orange is implied and then the yellow is realized or historical. So to summarize all of that, you want the orange line above the yellow line. And more often than not, the orange line does trend above the yellow line. If you trade something like a short straddle, it can make money. You can also get punched in the face pretty hard, because when you do get those really big moves that the market didn't account for, the account is going to feel it. So you have to size things very logically. Unlike young Eric, that sized that one thing so focused on what I was going to make that I didn't pay attention to what the path might look like. You have to pay attention to the path here. Otherwise, you'll get your face ripped off.
Mm. Mm. Great. Is it,
yeah.
Go ahead.
Yeah, a bunch of random stuff. The thing that I want to show your viewers specifically really quick, I just want to give them a taste of like something different, right? So that's the earnings play stuff. Something that's probably going to be more natural to a lot of your user base is the post-earnings announcement drift. This is really well defined as well. So we can start with the same exact process, see stuff that's reported earnings. For this one, I'm going to go back a little bit in time. What I want to do is I want to find things that have a strong move one direction or another. I don't care which way, up or down. And there's certain criteria that make the signal stronger than others in terms of EPS size, beats, and blah, 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 blah. But I'll show you the base effect. The base effect is super simple. The base effect is if we look at something like Palantir, which I have a play on. I've played Palantir for a while now. But after their earnings, they had a big gap up. The propensity is for things that have these big kind of gap ups. Again, depending on the type of stock, I don't want to overwhelm people, but I don't want to discount the nuance because it's less applicable to really big mega cap stocks and stuff like that. Just know that there's nuance here. But in general, the effect is if you see something have this nice big gap up, the propensity is for it to continue, at least in some duration, in the direction of that gap. Those post-earnings announcement drift continuations can be as strong as to persist over the entire following quarter. Think about what drives a gap. A gap normally is the market is pricing something one way. Something happened during those earnings that people thought was really good. They now have to reprice it. The market doesn't reprice immediately. It takes time. So that's what this persistent buying effect is post earnings announcement drift. And this can be to the upside or downside. So to summarize all of that into a simple box strategy that you can go tinker with, grab a list of stocks that recently reported earnings, look for things that have gapped up or down. Paper trade, say, okay, this one gapped down, this one looks super weak to me, I'm going to sell it here and see how I do. Same thing to the upside, you're off to the races.
Yep. And then, like you said, there's nuance here of like what you identify is for what you found to be successful. So not to oversimplify things.
Exactly.
So when you're out there practicing some of these ideas, definitely ask a lot of the nuanced questions like, maybe the market cap, maybe the float, maybe it's a sector, maybe it's X, Y, and Z. There's tons of ways to build, your own system. So just make sure, just understand trading is not as simple as sometimes we discuss it, but it's there's just a lot of nuance at the end of the day. There's a lot.
Yeah, and what Alex is mentioning there is just if you apply a really logical mindset to that, it's not that difficult, right? So you say, to your exact point, if a company has a smaller market cap and it has a bigger gap, that probably tells us something. That probably tells us that we're looking at a company that's likely to be growing in a really steady growth phase or aggressive growth phase as compared to a big mega cap company, right? So we might expect a different style move. So take exactly what Alex is saying and then just pass it through a logic filter, right? And see like which one of those might make more sense as a potential trait that you want to apply to the strategy. It's a great way to frame it.
Amen to that. So look, what I'm curious about, Eric, is I know people are probably going to be asking tons of more questions. They're going to be commenting. They're going to want to know, how can they learn more about you? Could you tell us how they can learn more about you?
Yeah, that's easy. I'm on YouTube at Outlier Trading, and then I have a website at the same. The biggest thing I would tell people is that if you have any rudimentary interest in options, there's a great book. Again, I'm not associated with him at all, but I look up to his work a lot. It's actually the one that's right there. It's called Options as a Strategic Investment. And it's kind of like a really good one-stop shop. So even if you're loosely interested in options, that dude made a great book. And I even think there's ebooks now, which I would recommend that over a physical text, because then you can control F and find specific stuff that you want fast.
Would you mind sharing that link with me, and I'll make sure to post it so people can find that book? Because I know there's a lot of people who want to learn more about options. So that'd be great.
Definitely.
Awesome.
Absolutely. Yeah. Larry's great.
Awesome. And we'll also provide a link to your YouTube channel just so that way it's easy for people to click on. But again, thanks for being here, brother, and I appreciate your time.
Absolute blast.
Thank you for finishing today's episode. If you're watching on YouTube, please leave a comment below of one of the takeaways that you are going to implement into your own trading. And if you happen to be listening on a podcast platform, go ahead and leave us a review and let us know what you enjoy about today's episode, because that does go a long way in helping us continue to grow. Again, thank you from the bottom of my heart, and I look forward to seeing you on the next episode.